say we're going to manufacture 8 shirts again. So 2 from last year plus 8 from this year gives us 10. So we will have 10 shirts. And also we can take into account all the products, for example, that were returned. Let's say last year or this year they bought 2 shirts, and those 2 shirts they returned them because they had a defect, right? They were not well made, okay? So those 2, we're gonna take them back, fix them. So 8 plus 2 plus 2 gives us 12. So we need to take into account all this. So, but how are we gonna balance with the cost of sales? We're gonna, now that for this year we have 12, we're gonna see how much we're going to sell this year. Out of the 12, how many are we gonna sell? Let's say we're gonna sell 10 of them. So for the cost of sales, it's gonna take that, those 10s will reflect there. But the balance will be 2, right? Because 2 shirts will not be sold this year. That's the purpose of the balance here. We are balancing what exactly we sold, what we didn't sell. Making sense? Okay, so basically now you can understand the progression. Here is the progression. You have these 3 costs: direct labor, direct material, factory. I hope you are seeing my mouse here. You have direct labor, direct material, factory overhead. These are going to come into the working process. You see them here: direct labor, direct material, factory overhead. On this side, you will have the finished goods, right? The finished good will be also its own account afterwards. On one side, you would have what came from the working process and what went out or what was sold, cost of sales. The cost of sales will also be its own ledger account, right? On one side, you have the finished goods and the trading account. The trading account will be its own account, right? Cost of sales versus sales. What do we want to see here? Trading. What does that tell you? Trading, selling. When we are selling, when we are engaging in selling, we want to see how much we're selling and what is the cost of that. For what purpose? In order for us to find the profit or the loss. Remember, sales minus cost of sales gives you the gross profit. You remember that? Everything is adding up together. And I want to show you something else, another way for you to look at this progression when you are writing your exam or you are studying. Working process, after working process, finished good, after finished good, cost of sales, after cost of sales, trading account, and then the profit and loss account. It's a progression. Does that make sense? Okay, let's move to an example. The best way for you to understand is an example. Here we have credit purchases of direct material. We're buying things on credit, right? That is going to go where? To your direct material on your left-hand side. Transport costs. I told you, you need to add the transport cost, right? 24,000, you add the transport cost. Direct labor will go where? To the direct labor account. You need to be able to identify each cost and send it to its correct account. Indirect labor, obviously, will go to the manufacturing overhead. Indirect material will go to the manufacturing overhead. Maintenance factory will go to the manufacturing overhead. All right? Sundry manufacturing overheads will go to the manufacturing overhead. Electricity, 75% is related to the factory. So you will only take 75% of this amount, 109,000. You will take 75% of that and you will send it to the manufacturing overhead. I trust that that's clear. Depreciation of factory equipment will go where? Manufacturing overhead. Depreciation of office equipment. You are not going to send that to the manufacturing overhead because it is for the office equipment. Salaries of admin staff, you are not going to send that to the manufacturing overhead because it's administrative staff. Selling expenses, all right? And rent. But rent, only 80% of rent will go to the factory. And that's what you're going to take into account. Does that make sense? All right. You have inventory on hand. Remember, the following information relates to Tesco manufacturers on the 28th February of 2008. So, but what happened in 2007? They tell you that this is what was left from 2007. So these amount will be beginning balance for 2008. Direct material that was left from last year is 189. That's why you see this as being the beginning balance for the direct material. So the beginning balance plus the credit purchases plus the transportation will form part of the direct material cost. Okay? But what was left at the end of 2008? It's 174,000. And that's why we don't take this into account. Do you see it here? 174,000 is going to be the closing balance. All right? That's how you can balance this account. Basically, you will take 174 minus the total of 558,000 will give you 384,000. So these 384,000 will be sent to your work in process. The direct material, as you see it here, it just the way it is, it's going to go to the work in process. You're going to add up all the manufacturing overhead. The total is what we are going to send to our actual manufacturing. Does that make sense? Perfect. All right. Yes. All right. So guys, then we move on quickly. So in our working process, we receive this from these three accounts: direct material, direct labor, manufacturing overhead. These exact amounts, that's what we're going to receive. But we're going to check, is there an opening balance for working process? Last year, at the end of last year, this is what was left for the work in process, 126,000. So that will be the beginning balance for this year work in process. Okay. And then finished good, it has an opening balance and it has also a closing balance for this year. Is that so? So that's exactly what is going to happen here. So for the work in process, we will have a closing balance, which we are not going to take into account. What does this mean? So when we add up everything, we have a total of 1,142,000 minus this amount, or you can look at this side. This amount is the exact same balance we're going to put here. All right. So it's basically this total amount minus what is going to be left out at the end of the year, or the closing balance, will give us the finished goods. That's how we balance it. And this exact same amount for finished goods will also be here. When you see work in process, it means that this amount is coming from the work in process. This amount here, it's coming from the work in process. Remember, there is an opening balance plus what came from the work in process gives us a total, minus the closing balance gives us the cost of sales. So we know how much was sold. Making sense, right? So quickly in this example, we will see therefore that, because in the previous example, we were asked only until the finished goods, right? But after the finished goods, what is the progression? Remember, after finished goods, we're going to be dealing with selling, right? Selling. We're going to deal with the cost of sales, right? So this finished good amount here, all right? So if it's given to you, you add it up here. If it's not given to you, you need to work it out. You need to work it out. For example, sometimes they're not going to give you the closing balance, but you now need to work out the closing balance. So that's why you see I write here TBWO, to be worked out. So if they provide you the closing balance, then you're going to use the closing balance to find the cost of sales. Because remember, you just take the total minus the closing balance, you find the cost of sales. But let's say, for example, they provided you already the cost of sales. For example, in this, look at this example here. Example 6.2. They provided you the cost of sales. Here it is. They provided you the cost of sales of finished product. It's 310,000. They provided you. So if they provided it to you, then you don't need to work out because it is given. You just add it up there. What is not given to you is the closing balance. And you can work out the closing balance by taking the total minus the cost of sales that was given. That's how you work out the balance. Easy there, right? But the purpose of this is to show you that from the finished good, we go to the cost of sales. The cost of sales, you see on this side, you have what came from the finished good. It means that these are the products that were finished, right? But that they were also sold. They were finished and they were also sold. But they are products that were finished, but they were not sold. Pay close attention here. So the product that were involved in the trading account are just this amount here. 310,000 were involved in the actual trading. And after that, we have a trading account. Obviously, the trading account will have the cost of sales and on one side, and on your right side, how much sales did we get? Sales minus cost of sales gives you what? Profit. That's how we will determine if there was a profit or there was a loss. We're going to look at the sales. This amount will be given to you minus the cost of sales gives us a profit, right? So if the sales is greater than the cost of sales, so it means that you've made profit. If the sales is less than the cost of sales, then you didn't make profit. So now you say, okay, now we have, Patrick, we have, what do we have here? We have the gross profit, right? Why do we need also another account that says profit and loss? Because we want to find the net profit. How are we going to find the net profit? We're going to take into account everything that was not manufacturing related or production related. Such as what? Electricity for the admin building, maintenance for the admin building, right? Or maintenance for the admin equipment, insurance for the admin equipment, distribution cost, advertising. These are not manufacturing related. Salaries of the admin employees, they are not manufacturing related. So these are other expenses we're going to minus in order to get the net profit. And this is how you're gonna get your capital. You see there, capital or net profit, that's how you will get them, right? You will take the total for the trading account, minusing all these costs, electricity, maintenance, insurance, distribution costs, advertising, salary. That's how you will get the net profit. Does that make sense? Wonderful. So what's gonna happen to the rest? Practice. So I've explained to you the progression, and I've given you even this a very important, very nice progression for you to understand. So sometimes you would say, listen, I don't want to memorize. Are they going to provide this into the exam? They don't need to provide it. You just need to understand that after the production, we are dealing with the finished good. After the finished good, we are dealing with the cost of sales because we are now selling products. Right? That's all you need to understand. There is a progression there. And I've provided you this, so use it. So we're going to move to the second part, which is just going to take us about 15 minutes, and then we're going to close, right? So there is two kind of statements that you need to be aware of. There is the production cost statement, all right? The production cost statement and the trading statement. Production cost statement and trading statement. What is the purpose of a production cost? It's just to report. It is a report that shows the cost of manufacturing finished goods or goods that are ready to be sold. So what are we talking about? We are only zooming and focusing on the production, right? And the trading statement is going to focus on what? On the sales part. That's all that it means. So we're going to have a statement. Remember, there are multiple statements. Remember your income statement. Remember your statement of financial position, your balance sheet. These are statements. They show you what we have, right? What has been done, right? The same thing for the production cost statement. So within this production cost statement, what do you have in this production cost statement? You have the three, you remember them, right? You remember those three. When I mention three, you know them. So we have the direct cost and the indirect cost or factory overhead cost, right? So the direct cost, what does it include? Direct material, direct labor, right? And the factory overhead cost, right? What those three gives us what? The total manufacturing cost. And then we're going to add what was at the beginning of the year, right? What is the opening balance at the beginning of the year for the work in process? Why? Because work in process is the actual production. Because don't ask me, aren't we using the opening balance of the finished good? No. The production cost statement deals with the production, and work in process is the actual production, right? So opening balance minusing the closing balance will give us the cost of production of finished goods, right? So for you to prepare this statement, you need notes, right? Notes to the financial statement. You know about this, right? You can't just go, you start writing direct material, direct labor. No. You need to have notes for your direct material cost, for your direct labor cost, and also for the manufacturing overhead, right? So what will the direct material cost include? This is not a ledger, so they're not going to be a left and a right side. It's just one side, right? You're going to have your opening inventory, the net purchase, plus all the freight on raw materials, custom duties, all these costs you need to add to the cost of the actual product, right? Remember again, I answered Yanula. So you don't only look at the cost of the product, you have to look at all the costs that are involved in the shipping, custom duties, and all these kinds of things. So once you add up all these costs, minusing the closing inventory, you will get the direct material cost, right? The same as for direct labor cost, you will have factory wages, pension fund contribution, medical aid contribution, UIF contribution, you name it. Whatever contribution you're doing for your employees, you add that together to get the direct labor cost, right? It's not a ledger, it is a note. And then the third one will be your factory overhead, right? What is your factory overhead? Indirect material, indirect labor, depreciation for the factory machinery, electricity, telephone, insurance, rent paid. All these will form part of your factory overhead. That's how you're going to add them now in your statement. Now you have the direct cost and the indirect cost, then you can get a total. All right? And then what else you need to check? You need to check now, what is the opening balance for the work in process at the beginning of the financial year? And you need to minus afterwards the closing work in process at the end of the financial year. This will provide you the cost of production of finished goods. Does that make sense? Perfect, perfect. I just want you to check number 4. Just check number 4 here for cost of finished goods sold. Remember, don't confuse cost of finished good and cost of finished good sold. I repeat that part. Remember that part? Very dangerous, right? So when we are dealing with the trading statement, now we are dealing with trading, selling the product that we have manufactured, right? What kind of product? Not product that we bought. This is not a retail business. It is a manufacturing business. So product that we have manufactured, finished good that we have manufactured, that we have sold. So don't just get finished good. You see, so you take sales minus cost of finished goods sold. How do you get the cost of finished goods sold? You first need to take the cost of finished goods, just finished goods. So the opening balance of inventory of finished goods at the beginning of the financial year, plus the cost of finished good produced during the year, right? So you are dealing with the whatever was produced, right? But minusing less closing inventory of finished goods. Do you see that? So now we know what was produced but was not sold. So we produce what was produced that was not sold minus the cost of all the product that we produced, including that was what was left last year and what is at the beginning of this year. So that will give us exactly what we have sold. I use a simple example. All right. Let's say last year we were left with 5. And this year we manufactured 10. What is the total? The total is 15. Now, what if they tell you, but at the end of the year, we were left with 5 that we produced, but we didn't sell? So you will know exactly how much we sold. How much did we sell? 5 plus 10 minus 5 that we didn't sell will give us exactly what we sold. So I hope this is clear. You can see it's quite clear in front of you. So remember to use the cost of finished good sold in order for you to get the gross profit. So that's it. Basically, that's it. That's the trading. That's the difference between the cost of finished goods sold and the cost of production of finished goods. Here you are dealing with the product that the product that was produced, and here you are dealing with what was sold. Okay? Is that clear, guys? So for the next 5 minutes, just before I wrap up and close everything, I want to just look at an example. And I have provided you everything so that you can see all the costs wherever they are going. Okay? So, for example, DM, you understand when I mean DM, what does that mean? Direct material, right? You understand that. When I say IM, what does that mean? It means indirect material. You understand? But that's the purpose. Every time they give you all these costs, you need to categorize them. When you read raw material inventory, you know that you are dealing with direct material. Work in process inventory. But remember, these are the balances. Balances in October of 2007. What does that mean? This is the opening balance. So there is an opening balance for raw material. There is an opening balance for work in process. There is an opening balance for finished good. And there is also an opening balance for indirect material. Interesting. But it doesn't matter. There could be an opening balance for anything. That doesn't matter, right? Now, you need also to categorize now the main cost. Remember, these are the closing balance here. They say balances on 30 September of 2008. Those are the closing balance. All right, fine. But for the year itself, the year of production, we need to take into account all these, right? Credit purchases of raw material, direct material. Freight on raw material purchases. Okay, part of direct material. Indirect material. They tell you indirect material on credit. Okay, this is part of indirect material. Oh, what is the sales of finished product? Finished product. Sales. Here is the sales. So now they tell you the factory labor. You have factory wages, pension fund, medical aid, UI. All these form part of the direct labor. Indirect labor, they tell you it's 71,000. That's indirect labor. Where is it going to go? Whatever is indirect, it's going to go to the manufacturing overhead. Electricity. You must be careful. There is electricity for the factory and there's electricity for the administrative office. Same principle as we've been dealing with, right? So those for the factory, we are looking at them and taking it into account in our production, right? And basically, this is how you're going to put all these accounts together. I've made it easy for you here. Oops, sorry. I've made it easy for you here, and here it is. So you have your direct material, direct labor, factory overhead. Make sure you practice and you practice for yourself so that you never miss out an account. But remember, this is not a ledger. This is the notes for to the financial statement. Notes to the financial statement. You start with the opening balance plus all the purchases, plus the freight, custom duty, you name it, minusing the closing inventory. Then you get your direct material. Direct labor, we talked about it, factory, pension, medical, you add them up together. Factory overhead, for only what is factory production related. So this will give you, for your production cost statement, the direct cost as well as the indirect cost, right? Factory overhead, right? It's going to give you everything to provide you with the total manufacturing costs. What else do we now add? We add the opening work in process minus the closing work in process. Opening work in process minusing the closing work in process will provide us with the cost of the production of finished goods. Is that clear? Oops, I can't see my screen. Let me just check. Okay, that's clear. Right. And then the trading statement is just a small statement. It's just sales minusing what? the cost of finished goods sold. Sold. You must remember that. Sales minus cost of sales. Sales minus cost of sales, right? So it seems like I've covered everything for this chapter. Remember, but for example, let me just cover this. This could be important for you guys. Remember the cost of finished goods sold. Cost of finished goods sold. How do we find it? The opening inventory for finished goods manufactured, right? Finished goods manufactured. Opening inventory of finished goods plus the cost of finished good produced. Produced, not sold, produced. So we take all the production into account, minusing what we are not going to sell will provide us with the cost of goods sold. The cost of goods sold. Now, here is a problem, for example. They didn't provide us with the closing inventory of finished goods. How do you know? Because when you look at the closing balance, finished goods product on hand does not have a closing balance. Do you see that? Clearly, it does not have a closing balance. But like I said to you, you take what you know and you find what you don't know. All right? But they provided us with the cost of sales for finished product. They provided us with that. You mean the one that we are looking for? Yes, they provided. So that's why you need to read properly. Here it is. So the cost of finished goods sold is the cost of sales of finished product. So you need to be understanding very well what they put there. So this will be the most important last thing I would say. So look here, the cost of finished goods sold, it's the same thing as saying the cost of sales of finished product. So if they provided it to you, then you can find what you don't have. All right, then you can find what you don't have. Easy. You take what you have, you find what you don't have, and the rest becomes easy. But these are the three things we've covered. The trading statement, we've covered the production cost statement, and obviously we have covered the ledger accounts with a right hand, a left hand side, and a right hand side that needs to balance. Guys, we have covered 1 hour together. So I just want to find out from you, is this making sense? Is it quite simple? Perfect. And guys, even if you say, oh, there's still some stuff I don't understand, you will understand. Everything will be crystal clear when you practice. So use these examples, practice for yourself, see what you are struggling with, and send your questions to the group to say, I'm struggling to find out this. I don't know where this came from. Let's practice together. That's the purpose of having a community of practice, right? But I know that if it's not perfectly making sense, although we have covered it thoroughly, but if it's not making total sense, it will make total sense when you practice, right? So I'm going to leave you with this. Just want to thank you, everyone who has participated. Thank you so much for having you guys.